capital allocation and the common pitfalls. The principles are fairly straightforward. Number one, cash is king. So for your NPV analysis, for your IRR analysis, the main thing is that we are going to look at cash flows. Tax, of course, has to be paid to the government. Therefore, we always take after-tax cash flows. And we only take the incremental cash flows. For example, let's say you're talking about adding a new roller coaster. Now, we'll just consider what is the cost of this new roller coaster and what is the new business that it will bring in for us. We're not going to look at our existing business or our existing cost. We're just going to be considering the marginal or the incremental cash flows, that what will be the additional cash outflow, what will be the additional cash inflow, and then we'll see if it makes sense or not in terms of NPV, that what is the cash outflow now and what will be the increase in our cash inflow over the next years. And again, timing is important because of course all of these are going to be discounted, as you already know. So as discussed, in terms of the principles of capital allocation, the first one is that always based on cash flows, not based on income or operating income. It is based on hardcore cash, and which means even expenses such as depreciation, which are non-cash, need to be adjusted. Secondly, we look at incremental cash flows only, right? Now, what does that mean? Let's say you have already got the theme park and now you're thinking of making the hotel. Now, if you have already paid a certain consulting fees for the feasibility of this hotel, that is something which you have paid. That cost is sunk. It cannot be recovered now. You have to take the decision now that should you further invest in making the hotel if the future cash flows are going to be worth it, right? But whatever cost has already been incurred, that is a sunk cost and it will be excluded. However, if there is any externality that, let's say, if you're going to make this hotel, there is, or let me give you another example. Let's say we're talking about a new roller coaster and we have an old roller coaster. Now, if we paid any consulting fees for the development of the feasibility of this new roller coaster, that we will not include in the analysis. However, if there are any externalities that, let's say, once this new roller coaster is made, it will reduce the sales from our old roller coaster because the same customers that are coming in will want to go on the new one. So that is an example of cannibalization, right? So we will include externalities, but we will not include your sunk cost. An example of a positive externality is coming back to the theme park and hotel example, that let's say you make the hotel and the theme park sales go up because usually people drive from far away and they probably just come to the theme park for one day and then go back home. But if you make the hotel, maybe they'll stay in the hotel for a few days and keep coming back to the theme park for a few days. So the theme park sales might go up as well because of the close by, close proximity hotel. That would be an example of a positive externality. And when you're deciding whether to make the hotel or not, then that is something you will take into account. Of course, timing of cash flows is crucial because we discount these cash flows and we calculate the impact of time value of money. And money received earlier is more valuable than monies received later. Now coming to the world of pitfalls, and here there are two types of pitfalls. One is cognitive, which is calculation problems, and the other one is behavioral, which is judgmental issues. Now, these terms you should not only remember for capital issuers, but also it's going to be very helpful for your CFA studies all through the three levels. Cognitive is related to your mental thinking and processing, and these are solvable. These are fixable, easily fixable, right? Because they're like a calculation error, can be fixed. But behavioral are emotional, right? These are emotional and these are hard to fix. And when I will take you through the material now, you will understand that how the behavioral ones are going to be relatively harder to fix compared to the cognitive errors. So what are the cognitive errors? Maybe you did some error in sales projection, right? That how many new customers are going to come in and stay at the hotel or use the new roller coaster. So this is just a calculation error, can be easily fixed. Or you used the profits or the positive cash flows from your existing roller coaster, right? And you said that I will use this profit to construct the new roller coaster instead of borrowing money from the bank or instead of issuing new shares to my equity investors. So you're using your internal money or internal financing and you're saying that money it's my profit, so there's no cost to it. Well, there is a cost to it. It's called opportunity cost. You can invest that money somewhere else and earn a positive return. You can put it in the bank and earn some positive return on it, right? So this is also a cognitive error. It's just an error in thinking, and it can be fixed by explaining to the corporate finance team or the strategic planning team that, hey, why are you assuming that there is no cost of internally generated funds? Or maybe the team is making an error of ignoring inflation, that they have taken sales projections, right? But they have not grown the sales amount with the increase in prices, because of course prices go up. Or maybe they are assuming that prices are going up, but they are not assuming that your costs are going up. So on both sides, we need to make sure that we take the impact of inflation, and instead of nominal, we should take real cash flows. That means they should be adjusted for inflation. There is no problem taking nominal either, but if you will take nominal, then the discount rate that you should take should be nominal as well. And if you are going to take real cash flows, then the discount rate that you take should be real, and here it should be nominal. So this is something you have to be careful of. So let's discuss each one of these cognitive errors in a little more detail. Forecasting errors: maybe you didn't take the correct discount rate, you didn't make the correct sales forecast, right? You didn't make the correct cost forecast, maybe because of course these things are difficult to estimate, and I have done this work, so it's not so easy to estimate projected sales and projected expenses. Maybe you incorrectly added some sunk costs which had to be left out, or you missed some opportunity cost of certain things such as internally generated financing, which brings me to the second cognitive error, that sometimes people assume that internally generated funds are free, that there is no cost associated with them, which is wrong. Of course, there is an opportunity cost associated with them, because you can invest that money somewhere else instead of investing it in this project. Or maybe there is a piece of land which is free because, it's your piece of land, and you're saying, okay, I'm going to make a project on this, hotel on this, and my initial cash outflow is only going to be the money I have to spend on construction. And then you will compare it to the future cash flows. That's going to be wrong, because that piece of land again is, even though it's yours, but you need to take that piece of land into account, because you can sell it instead of using it as land for your hotel, right? So there is an opportunity cost. And then lastly, of course, if you're going to take nominal cash flows, then you should take the nominal discount rate. Nominal cash flow should be discounted at the nominal discount rate, and real cash flows need to be discounted at a real rate, which is basically your nominal adjusted for inflation. Now let's come to the more difficult biases, which are your behavioral, and these are emotional in nature, very hard to counter, right? And let's discuss each one of them. First one is inertia, and it's just that because you've been investing in a certain business segment and you keep doing it because that's just a momentum that has been developed. And think of things like iPod, right? Apple iPod. Clearly nobody is using it anymore, right? But maybe there was a time when Apple was still investing in R&D of iPod and coming up with new iPods, even though the business was not going to be there anymore, because iPhone and everybody's phones, other phones, everyone just now uses phones to listen to music. Nobody carries an iPod or a Walkman around, for that matter, right? So inertia is obviously something that we need to be careful of, but this is emotional in nature, and it's very hard to convince management that this particular business segment is not going to be around. So please stop investing in it. Second thing, usually management has their compensation tied to the earnings of a business instead of cash flows, right? But what we need to look at is cash flows, because as far as your shareholders are concerned, they are going to be interested in what is the value, the net present value, and that of course comes based on cash flows, not on earnings. But since the bonus of your senior management might be linked to earnings per share, they might prefer those projects which have a higher earning instead of those ones which have better cash flows. Thirdly, you might have some pet projects backed by senior management, and they might be kind of hallucinating about those projects, and they might think, oh, this is going to be the best project ever. They might be very optimistic about the projections, which might not be practical. And then lastly, failing to consider alternatives, and this is again linked to your management having a certain preconceived notion of a certain situation, and they might miss out on alternate realities during the idea generation stage. Okay, now moving on to real options, and this is a very interesting concept, that let's say you are having your theme park set up and now you are going to make the hotel, right? So first of all, timing option. So this is a real option, example of a real option, timing, that once your theme park is ready and it's doing well, a lot of people are coming. So what you could do is then you could get a piece of land next to the theme park and maybe start making your hotel. So this is a real option in terms of timing, that you can do the second project, which is the hotel, once you know that your first project is successful. You can also have another type of real option, which is expansion, that depending on how well the theme park has done, you could have a hotel, much bigger than what you had initially thought of. So maybe you could go for a bigger option. And that's where flexibility comes in as well, that the pricing or there could be so many different things that you could have in the hotel. Maybe you could even have a resort combined to this. The pricing could be premium. Maybe you could have some kind of theme coming in for the hotel as well. So your flexibility options can be there. And finally, there is a type of real option which is called fundamental, that you don't do the project at all, right? You just decide not to do it. Or even if you've purchased these pieces of land, you could maybe sell those pieces of land. So there could be alternate ways that you could still generate money even if you decide not to do the project. You could salvage the assets and do something else with it. So these are the types of real options: timing, sizing, flexibility, and fundamental. Let's go through each one of them. So timing is obviously delay doing the project until you have better information. Sizing is either doing it in a bigger way or a smaller way, right? So you can make additional investments when the results are strong. So you have a growth option. Or you can make no investments when the results are weak, so you can abandon it. And I think a good example is, if the theme park does well, you go for the hotel and you go for additional roller coasters. If the theme park doesn't do well, you don't go for the additional roller coasters and you don't go for the hotel. Flexibility, let's say you have two different theme parks. One is based on a Disney theme, and another one is based on, let's say, Warner Brothers. And then you see which one does better, and whichever one does better, then you can have a hotel coming up based on that theme, depending on whichever one does better. Fundamental, of course, is that you don't do that investment altogether, right? So you make a feasibility and then you say, okay, if let's say you're talking about an oil refinery and you say, or an oil exploration drill, and you say, if the oil price will be high, then I will go for it. Otherwise, I will not drill this well. Now, how can this be tested in your exam? So from an exam perspective, how do you apply this? And the answer is that we're going to do a question which is coming up after this slide, but I just want to explain the concept to you before we get into the question. Is that you're going to calculate the NPV, where you just take your first cash flow and you take your subsequent cash flows, discounted of course, without having any consideration for options. And then you can have some consideration for options, where you basically say that, okay, my NPV without the consideration of the options, and then let me subtract the cost of the option and add the value of the option. If obviously that option is coming for a certain price, then you will minus the cost and you will add the value, and then you will see the updated NPV. And this question is going to help you understand how this can be applied. Again, of course, this is from your curriculum. So if it's going to be in the exam, most likely this is going to be the way it can be tested. So here's this company, Gerhardt Corporation, and it's thinking about investing 500 million euros cash outflow at zero. So negative 500 million. 60% chance that this 500 million becomes 750 million. Or a 40% chance that it becomes zero. Now the first part here should be easy for you. That what is the NPV? The NPV is going to be minus 500 plus 750 after 1 year. But there's only a 60% chance of that happening, right? And this will be discounted back by 1 plus r to the power of 1. 10% is the rate, so that means this will be 1.1 to the power of 1, and you can calculate the NPV. That's fairly simple. The confusion is going to be, what are you going to do if you consider the real options? Now here I would request you to pause the video, try and use your mind and see what you can come up with. Okay, so what we're basically going to be doing is we'll be taking this NPV, which is without the options, right? and we'll be making some adjustment. Now there is no cost for the real option, so we don't need to minus anything, but we however need to add the value we're going to get from these options. And the value is, if we are going for this 40% chance that there is a failure, after that there is a 30% chance that we could get 600 million, right? And that needs to be discounted by 2 years. And there is also a 30% chance, after the initial 40% chance, there is a 30% chance that we might get 400 million. And this also, of course, needs to be discounted by 2 years. The last one is 0, so we can just ignore that. And that is what you see over here, that in the first one, without the real options, of course, all you have to do is take that initial cash outflow, take the cash inflow, multiplied with the probability, and that gives you the answer to the first one. And without taking into account the real options, your NPV is negative. So if you are not considering your real options, you will not be going for this project. But look at what happens when you consider the real options. So this is obviously your NPV without the consideration of real options. And then now we're adding the value from the real options. How? 30% chance that if that 40% situation happens where it is a failure, you can get 600 million, and 30% chance that you can get 400 million. And both of these will be discounted back by 2 years, because that happens in the end of the second year. And now the NPV, after adjusting for the real options, is positive. So now you will go for this project. So that is it for this learning module. Let's have a look at the summary. We talked about different types of capital investments. 2 types are there to maintain business, going concern projects related to efficiency, and regulatory ones are of course related to compliance. Then you also have projects for expansion within your business lines or related business lines, and other projects are completely unrelated business line expansions. What are the steps? There are 4 steps that we discussed for the capital allocation process: idea generation, investment analysis, planning, and post-audit and monitoring. Planning and scheduling. You basically have to look at the bigger picture over here in terms of all the projects that you are looking at. Then we talked about NPV and IRR. We talked about their pros and cons, and how NPV doesn't take into account the size of the project, and that's why we came up with return on invested capital, which looks at the profitability as a percentage of the invested capital. And here, of course, in the numerator, interest is not deducted when calculating the after-tax profit, because this is operating profit. Operating profit is earnings before interest and tax, but you just need to deduct the tax from here. So this is basically, this numerator basically is earnings before interest, and tax is deducted. So this is basically earnings before interest. And why we are not deducting the interest in the numerator? Because debt is also included in the denominator. So this is your long-term loans plus your equity. And equity, of course, includes both the common stock and the retained earning. All right, then we talked about the principles of capital allocation, that all cash flows are after tax and all decisions are based on cash flows, and that even marginal or incremental cash flows. You don't take sunk costs, and you take externalities, whether they are negative or positive. Both externalities are taken, and of course timing of the cash flows is crucial, because you're going to discount it. The further out they are into the future, the less their present value will be. And of course we talked about the pitfalls, which could be cognitive and behavioral. Within cognitive, we talked about these 3 types of forecasting errors, or ignoring the cost of internal financing, or not treating inflation properly, because if you're taking nominal numbers, then you have to take the nominal discount rate. If you're taking real numbers, then you have to take the real discount rate. And we talked about behavioral biases, where you could just be doing projects because you have been doing it in the past. You could be taking decisions based on accounting numbers instead of cash flows. Management could be pushing their pet projects, or they could be failing to consider alternative realities. And finally, with real options, you have timing, sizing, flexibility, and fundamental options. And how to bring that into your NPV is that you calculate NPV without the real options minus the cost and plus the value of the real options.